Hello and welcome to this latest in a series of live programs from Baillie Gifford, where we talk to the managers of the company's range of investment trusts. Today, the subject is China, and my guest is Sophie Earnshaw, who co-manages the Baillie Gifford China Growth Trust, along with Roderick Snell. I'm Richard Lander of CityWire, and I'll be talking to Sophie for about 25 minutes. And what a time to be having this chat, because rarely has the Chinese saying, "May you live in interesting times," been more appropriate. So much going on there. We want to hear your questions for Sophie, so please submit them at any time during our discussion via the Q&A box in Zoom, and we'll take as many as we can after our discussion. Sophie, welcome. Thank you for joining us. These are amazing times, and China's had this triple whammy of headwinds in the past year. We've got regulation, an uncertain geopolitical background, and now Omicron and China's pretty fierce attempts to eradicate COVID. Can you talk us through these factors and the effect that they've had on the investments that you're in charge of?
Yeah, okay, thank you for the question. Let's take each of those factors in turn. In terms of regulation, firstly, I think there are two key drivers to watch. The first is common prosperity, and the second is data regulation and anti-monopoly. Both of these drivers, we think, have been misunderstood by the market as an attack on the private sector. Now, this is a view that we strongly disagree with. So with regard to common prosperity, we continue to believe that success here should be a significant positive for many of the companies in the investment trust portfolio and for China as a whole. So as many people are aware, China's economic miracle has already pulled around 800 million people out of poverty. But it's also created vast inequalities of income, education, healthcare, and opportunity. And this inequality is largely felt along rural and urban lines. Educational outcomes here are really very stark. So 75% of urban children go to university, whereas 15% versus 15% of rural children. And the important point here is that 2/3 of China's children are actually rural children. So with China losing its low-skilled manufacturing jobs to countries like Bangladesh and Vietnam, the risk is that China's left with a large underclass of under or unemployed citizens who are unable to contribute to the next decade of consumption-led growth. So common prosperity is really the government's attempt to tackle these issues so that it can meet its development goal of attaining developed market status by 2049, which is the 100th anniversary of the PRC. The second regulatory driver, as I said, is anti-monopoly and data regulation. So we've seen a host of top-down regulation on data, both consumer data and commercial data, its use internally and externally. We've seen anti-monopoly probes into all of the big platform companies. We've seen regulation clamping down on practices such as differential pricing, forced supplier exclusivity, and on disorderly expansion of capital. Now, the first point to note here is that this is a global rather than a local issue. So countries around the world are struggling with how to regulate large technology platforms and their use of data. The second point, and the really important one, is that a lot of this regulation has been sensible. At its core, it's aimed at ensuring that companies continue to treat customers fairly and that opportunities for growth are available to all, in particular, available to some of the smaller companies that are the backbone of China's economy. Now, that being said, it has been poorly signaled and it's been very blunt. And this has caused significant volatility in the market and overall a compression in valuations. And then the third factor is geopolitical. Now we saw this in the second half of last year with the sell-off in ADRs on the back of the US's Holding Foreign Companies Accountable Act. More recently, so in January, February of this year, we saw this risk with the sell-off in Chinese shares post Russia's invasion of Ukraine. Since then, China has made its position on Russia much clearer. So we've had Ambassador Qin Gang stating that Ukraine's sovereignty must be respected and calling for an end to the war. It's likely that China will remain neutral in the sense that it will continue to abide by US sanctions but not impose its own. So the question is really, are we likely to see secondary sanctions placed on China? I mean, here the US has said that if China supports Russia materially, it may face additional sanctions. Unfortunately, they haven't explained what material support means. So the risk here, and it is a real risk, is that China believes itself to be abiding by US sanctions and then inadvertently oversteps the mark. So final point here would be Omicron, as you mentioned. So on Omicron, I mean, China's zero COVID policy was incredibly successful at containing the earlier variants of COVID. But with the more transmissible later variants, it's proving difficult. So we've seen Shanghai go into complete lockdown, along with some other big cities. And this is having a negative effect on economic growth and on consumption. Now, the outcome of all this is, MSCI China All Shares, which is our index, has given up almost all of its gains, and it's fallen to levels that were last seen in 2017. It's trading on now around 10 times earnings. So the result of all this is really big falls in share prices and in some cases very cheap valuations.
Lovely. So right now, what would you rate as the risk that's likely to fade most quickly, and which one will hang around? How does that factor into your outlook?
Yeah, I think regulation is probably the one that had the biggest effect last year, but also the one that is likely to improve soonest. So since December, we've started to see significant political capital building behind the idea that regulation needs to be better signaled, it needs to be more transparent, it needs to be less disruptive. And this is particularly with regard to the platform sector. So we had Vice Premier Liu He argue for this at a meeting of the country's top financial policy-making body. This followed similar comments from Liu Shangxi, a fiscal policy advisor at the two sessions. And that followed statements from the Central Economic Work Committee back in December, which called for greater stability and better signaling. Last week, we had Li Keqiang. He became the highest profile voice to add his voice to this group. And following that, on Friday, Xi Jinping called a meeting of the Politburo where he stated that normal supervision of the platform economy would resume and that there would be specific measures to support the platform economy potentially rolled out. So at the end of last week, we did see a small relief rally in some of the platform companies' share prices, with these companies' shares going up 10-20%. But again, this is nowhere near these companies should be trading at. And then on Omicron, there are signs that China is gradually starting to move away from its zero COVID policy. So it's approved Pfizer's Paxlovid antiviral treatment. It's also issued individuals with antigen tests for the first time. And then, I mean, more broadly on the macro, the government has announced a number of stimulus measures to buoy up economic growth. And let's not forget that China is in a much better position to stimulate economic growth, really a better position than any other country in the world. Inflation is running at less than 1% versus, say, 7% in the US. And domestic savings are incredibly high.
Right. Okay. So changes are in the wind, but that would sort of point to what people have been saying about investing in China for years. It's uninvestable, or at least it's too risky with a communist government, which is very difficult to read. Do you think that that's the case, or is that just, well, that's investing in emerging markets? You've got to take that into account.
Yeah, I think it depends on your risk appetite and your time horizon. So it's quite right to note that China's political system is different. The government views itself as investor, as regulator. China's political system is marked as Leninist, and the Leninist component of that is very important as it signifies control. So the government is the ultimate controller of the system. However, when you look at the government's aims for China, they are laudable. So she talks about, this next sort of 10, 20 years as being where China will be focusing on internal rejuvenation. And he has, as I said, this aim for the country, for China to become a developed market country by 2049. It wants to become a global innovation hub in a whole host of sectors. So there's plenty to get excited about for growth investors, and a good degree, I think, of a very long-term alignment. That being said, it is investing in China. I think whether it's suitable for you or not is very much dependent on your appetite for risk and volatility and your time horizon. So this is an emerging market. It is incredibly volatile, partly because of the government, but also partly because, in the Asia market, 80% of trading volumes are retail volumes. So it is a volatile market. And it is really a market where you need, as a result of that, to be able to commit to at least, a 5-year, ideally a 10-year investment horizon. And if you can commit to that sort of investment horizon, then I think it could be a very exciting asset class for you as an investor. But if not, then I would say it isn't for you.
Right. Okay. You and me and everybody has been stuck home for the last 2 years, but I don't know whether you got out to China yet, but Baillie Gifford does have a team on the ground in China. What is their intelligence telling you that perhaps does not get into the media?
Yeah, so we have a Shanghai office, which was opened in 2019. So we've got boots on the ground. And no, sadly, I haven't been able to get out to China since the beginning of 2020. But what are our Shanghai team telling us? I think it's the degree to which China is innovating, and just the exciting plethora of new companies that are being created. I mean, this is what they really convey to us that I think you don't hear a lot about in the headlines. So, for example, China's desire for self-sufficiency in semiconductors. This has really been strengthened recently by tensions with the US. So, we bought last year a company called SG Micro. It's a fabulous chip designer. They make analog chips, so their chips convert real-world signals into digital signals. Now, China, in terms of its self-sufficiency, it makes up around 60% of global demand for chips, but it's only 20% self-sufficient. SG Micro is the domestic #1 leader in this space. And not only is the industry growing, so its chips go into things like industrial control, into the automotive sector, they go into Internet of Things, but also there's this very large sort of market share gain story that I think will come about as China increases its self-sufficiency. SG Micro is a key beneficiary of this. Other stocks that we've been recently buying that you don't hear about, Sinocera is another one. One of China's policy priorities for the next decade is to improve its ability in advanced materials manufacturing. And again, Sinocera is one of the domestic leaders here. So it's stuff like this that you don't hear about in the press, but we do hear a lot about from our team on the ground.
Great. Okay. So you get all this information from the team in Shanghai, but such volatility over the last year. What should and can you do as a portfolio manager to keep your investments on track?
Yeah, it's obviously been a very difficult year, but what do we do at times like this? We really try and double down on what we do best. So we stick relentlessly to our philosophy and process. As you know, Baillie Gifford has been investing in China for almost 3 decades now. We began investing in, I think, 1994 via our dedicated emerging markets funds. So we've experienced numerous economic and political cycles. We've experienced drawdowns like this in the past. And what we've learned is that at times like this, it is just incredibly important to stick to what you do best. And for us, that means remaining incredibly long-term, continuing to do that fundamental research on stocks, and then making sure that we have the best information sources available to us. So, more recently, we've been speaking to some of our academic contacts to help us understand the regulatory backdrop. So, a book I'd recommend anyone read is, it's called Invisible China. It's by a academic called Scott Rozelle. He talks about some of the challenges that China is facing in terms of income inequality, and that, talking to him, listening to him, and reading that book has really helped me to understand what common prosperity means. Similarly, speaking to some of our contacts at Oxford University, their China Center, hearing Rana Mitter talk about China's political system and how that's evolving has been incredibly helpful. And then also continuing to speak to, companies that are operating on the ground. For example, we had a call with Wang Xing, Meituan's founder, recently. So it's really doubling down on what we do best, continuing to research the stocks and continuing to think long term.
Right. And through all of this, has this changed your perception of China's investment potential, do you think, compared with, say, a year or 18 months ago? Has it made you feel more confident about the long-term investment case for China?
I don't think it's changed my base case on China, which is, as I said, that I still remain incredibly positive regarding it as an asset class. I still think that the type of companies that you can get access to within China are increasingly world-class. They don't just stand out within an emerging market context, they stand out globally. And then some of the growth opportunities that they have access to are really, phenomenal and opportunities that you don't find elsewhere. I think the geopolitical risk has risen quite markedly, and I don't think that's going anywhere. But again, as I said, it really does come back down to your risk appetite and your investment horizon. In terms of the stocks and their investment potential, we have made a couple of changes to the portfolio. For example, we've sold a company called Huya, which was an online game streaming platform. A big part of the investment case for Huya was that it would hopefully merge with the number 2 player, Douyin. And with the anti-monopoly regulation that's come out over the last 18 months, we don't think that's likely. So we've moved on from that. And then iQIYI, which is a sort of Netflix of China. It's a long-form video platform. And there again, a large part of the investment case was based on a much more rational sort of competitive environment and greater collaboration between iQIYI and the number 2 competitor, Tencent Video. And again, given the domestic regulatory backdrop, we don't think that's likely. So though at the stock level, there are 2 companies where we think the investment case has changed and where we've therefore moved on from.
Right. You mentioned a few tech stocks and hardware and software a short while ago. Which other sectors have you been adding to positions over the last year?
So we've been adding to some of our healthcare names. So in particular, a company called BeiGene, which is a cutting-edge oncology drug development company, and KingMed, which is a diagnostics company. Both, in fact, the entire healthcare sector has sold off over the past year, largely as a result of concerns regarding regulation. Now, the government has been trying to sort of revolutionize China's healthcare industry for about 5 to 7 years now. They really want to create a sort of innovative biotech hub that could one day challenge the US. But they've also been clamping down on companies that are selling drugs that don't work or very high-priced generic drugs. Our exposure to the healthcare sector is very much in the innovative space that the government, we believe, wants to support. And they've been sold off along with all of the generics companies. So we think the sell-off in those two names in particular is unwarranted, and we've therefore added as a result. Other names that we've added to recently in this advanced manufacturing space, we have two companies, one called Eston and one called Innovets. Both of these companies are A-share companies, and they supply components and robotics to factories and for automation. And these are two names that have been weak, but we feel have a really exciting growth opportunity ahead of them. Again, China wants to increase its self-sufficiency when it comes to robotics. It really wants to build its own domestic FANUCs, if you will. And we think that Eston and Innovets have a real shot at being China's sort of domestic champions in automation.
Right. You've referred a couple of times there to being self-sufficient, to keeping up with the United States. I mean, is this a sort of red thread that goes through Chinese economic and fiscal policy in terms of backing certain industries, so that even if the States cut them off tomorrow under some hostile president, they would still be able to operate?
Yeah, and I mean, since the US became much more aggressive with its sanctions, China has really doubled down on research, on development, and on it's really trying to tackle some of its self-sufficiency issues. So it's investing huge amounts into areas like semiconductors, advanced manufacturing. And in terms of Chinese companies that buy these components, we've started to see a huge amount of Chinese companies search for alternative suppliers to US. So there will be, at the very high end, there will be still issues, but at the lower end, a lot of these companies are now much more self-sufficient and have been able, in some instances, to switch largely to domestic suppliers.
Great. You had a beautiful piece on your website about Generation Z, nicely illustrated and talking to these people. Tell us a bit more about who Generation Z is, how big it is, and what do they represent about Chinese consumption?
Yeah, so Generation Z, it's those consumers that are born roughly after 1990 or after 1995. There are differing estimates on the size, but somewhere between 250 and 300 million consumers within China that broadly fit within that bracket. What's interesting about them is that they have radically different consumption habits and brand preferences relative to their millennial and then older compatriots. So, they typically prefer local brands as opposed to multinational brands. So in the sportswear sector, for example, a stock we own is called Li Ning, and it's increasingly being able to compete at similar price points with the likes of Adidas and Nike. And it's because of this shift in sort of brand preferences amongst these younger consumers. These consumers typically prefer local skincare brands as well, like Proya, for example, which is a stock that we own in the portfolio, as opposed to, say, a L'Oreal. So they have a huge amount of disposable income and consumption power, and very, very different tastes. So they're much more culturally confident than their peers, and they express this via a preference to domestic Chinese brands. This is really I think a sort of 10-year story that we'll see play out over the next decade in China.
Right. Okay. Great. And away from consumption, we've got other areas that seem to be coming along, particularly clean energy. What is China doing there, and how is it encouraging innovation?
Yeah, so clean energy, renewables is a really exciting growth opportunity for China. So, the government has committed to net zero by 2060, and then it has milestones at 2025 and 2030. It's making huge progress towards those milestones, although we shouldn't expect this to be a sort of linear kind of progress. And a lot of the companies that we own in the portfolio are really enabling this switch towards renewables. So, you know, we own stocks like CATL, which is the largest EV battery manufacturer globally. It has a remarkably strong competitive position within China, around 50% market share. I think if any country is going to properly adopt electric vehicles, it's going to be China. I mean, most recently, the data we saw was that 20% now of new cars sold are EVs. So, you know, this is miles ahead of any other country. And as I said, yeah, CATL is really enabling this. In addition to EVs and batteries, we have a company called LONGi Green Energy. So this is another A-share company. It's a world leader in solar module manufacturing. So it supplies roughly a quarter of the global market for solar wafers and modules. If governments are going to meet their carbon reduction targets, we should see solar installation potentially triple by 2025 and then triple again by 2030. LONGi is really a leader globally. You know, it's not just a leader domestically, and it's a good example of a Chinese company that you know, really can lead on a global stage in terms of its manufacturing capability and its R&D capability. In addition to that, we have a company called Yunnan Energy New Material, which is a separator maker for large form batteries. We have a company called SunGrow, which is an inverter maker, and they're effectively a supplier to companies like LONGi. And we then have a mining stock called Zijin Mining, which is a copper producer and again an enabler of China's green infrastructure. So I do think that renewable energy is a really exciting growth opportunity, particularly in China, and actually a lot of the leading companies globally are based in China. Great.
That's probably enough of our discussion, so we'll move on to the questions that have come in from the audience. The first one is, what will China look like in 10 years' time? How different will it be from today?
That's a great question. I mean, we've already seen huge changes in China over the last decade. I mean, some stats. So since 2000, so 2 decades, but still, since 2000, China's gone from less than 5% of world GDP to closer to 20% today. You know, in 10 years' time, could it be the world's largest economy? I think so. It's still, in terms of MSCI's global indices, China is only 4% of global indices. Now, Apple, the iPhone maker, is 3.5%. So Apple is almost as large as China's whole weighting within global indices. So, you know, where's that likely to head over the next decade? It's one of the few countries globally that is underrepresented in indices relative to its economic weight. You know, China's already got the second largest stock market in the world with over 4,000 listed companies, yet foreigners own less than 4%. Again, I'd expect that to increase over the next decade. And then in terms of, you know, the opportunity set, this has also changed drastically over the last 10 years. So 10 years ago, the new economy accounted for only, I think, 30% of MSCI China. It now accounts for 60%. And as I said, as China continues to double down on R&D, it's really creating world-class infrastructure, you know, 5G, the cloud, advanced manufacturing, and the pace at which we're seeing new companies created is phenomenal. So in 10 years' time, I think the investable universe in terms of type of company and quality of company will be even better. Now this, I mean, just to add a note of caution, this is the bull case. But there is, you know, a non-zero chance that this won't occur, and that instead, you know, China's economic development will be stalled. Here, I think we have to think about economic sanctions and technology controls, potentially a mistake in leadership. You know, we've got to remember, I think, that this type of growth and this type of development is very, very unlikely to take place in a straight line. And I think the last year and a half has been a timely reminder of this.
Okay, we've got a few people asking about leaning, and you talked about that and its potential. Do they have the does it have the wherewithal to beat off these international brands like Nike and Adidas? And in fact, one viewer says, as nations get bigger, younger people want to emulate and buy global brands. So seems a bit counterintuitive why they want to buy a domestic brand that probably didn't exist a few years ago.
No, I mean, Li Ning has a very long heritage. So it was founded in the 1980s, I think, or early 1990s, by China's a gymnast, Mr. Li Ning, who competed at the Global Olympics. So, the brand has a incredibly long heritage. And I mean, interestingly, it's exactly the reverse of what the question implies. So what we're seeing on the ground is that, for millennials and for older Chinese consumers, it was all about, as China opened up under Deng Xiaoping, and then more recently, it was all about buying multinational brands. As a status symbol, you don't buy local Chinese, you buy Adidas, you buy Nike, you buy L'Oreal, because that's what you aspire to. You aspire to be sort of Western and global. But what we're seeing now amongst this younger generation, and I think in some instances you have seen it, you've seen it with, for example, the US, as they've become a world superpower, their brands have sort of taken over the world, and US consumers typically like to buy US brands. You've seen it in the cosmetics space in a number of different countries, for example, in South Korea and Japan, where historically these markets were dominated by multinational global brands. And then as these countries developed and became more sort of culturally confident, consumers switched to local brands. And this is exactly what we're seeing amongst this younger generation. They are incredibly proud to be Chinese, and they've grown up during a period when China has been continually on the front foot. In terms of their view, China outperformed the rest of the world during the GFC. It's outperformed until very recently in terms of COVID. It's built these phenomenal, very large, very successful platform companies that have multi-billion-dollar market caps. So there's a huge amount now of cultural confidence and a real desire to express this by buying local.
Okay. Another question is about property. I mean, it's one thing. I assume you have very little in the portfolio because it's not part of the growth economy, but the debt and the sort of financial fragility of the property sector, is that a problem in terms of overspilling into the areas that you do invest in?
Yeah. So yeah, as you rightly said, we don't really have anything in the property sector. We've got some sort of tangential exposure via a company called K Holdings, which is effectively the sort of right move. It's a very loose analogy, but kind of like a right move of China. And we also own a company called Glodon, which is a software provider to the property and construction industry. But in terms of the property space, we've seen big sort of headline grabbing upsets from some of the big companies there, Evergrande, for example. But if you look at the debt of some of these companies that have blown up, it is very small relative, to China's assets and to the rest of the economy. As I said earlier, the government has a huge amount of levers that it can pull to stabilize the property market. And, I think Xi Jinping last week and some of the other leaders announced that they would be effectively stimulating the economy. This is a very big year for China, given in October we'll see the re-election of Xi Jinping. So I think China has a huge number of levers that it can pull to keep the property market stable, and as such, it's not something that we are particularly worried about.
Okay, just to hark back to geopolitics, someone has asked, does Russia's lack of success in invading Ukraine make the possibility of a Chinese claim on Taiwan more likely or less likely?
The CCP has, prior to Xi Jinping, has for a very long time talked about Taiwanese reunification. So it is very much on the agenda, but from what I understand, a military sort of solution to that, I think, would be seen as a real strategic failure for the Chinese, even if that military, action was successful. So I think a sort of military reunification of Taiwan is incredibly unlikely. I think that Russia's invasion of Ukraine has made it even less likely, given the problems that Russia has experienced, and then looking at Taiwan, which is obviously an island, and therefore even more difficult to sort of militarily attack, if you will. So I think it was a low risk anyway, and I think Russia's invasion of Ukraine has made it even lower risk. Right. But we should expect, as I said, the CCP has talked about reunification of Taiwan, and it is very much on their agenda. But I think their hope would be that it would be a political, a diplomatic sort of solution.
Right. Couple more questions. One is someone who looked at your Gen Z, Generation Z treatise, and you got a lot of independent thinkers in there. Is that going to cause a problem? It is a fairly politically repressive state. As this new generation of independent thinkers comes around, are they going to cause unrest? Are they not going to accept the power of the state in the same way as their parents have?
I mean, the contract for a very long time in China has been that limited, or willingness to accept limited sort of political freedom in exchange for economic improvements and improvements in standards of living. And I think, as long as the government continues to deliver on that, I still think that the political system will stay as it is. China has its own very rich history, and very long history. And, even prior to the CCP, democracy hasn't really figured. It is a very large country. There are challenges in terms of maintaining or sort of controlling that number of sort of people. So I think China has a very distinct and sort of unique history that means that it probably is on a very different course politically to the rest of the world. And I think one of the things that the West perhaps got wrong about China is that as it became more economically developed, it would, of course, switch to a more democratic system. And it hasn't done that, obviously. And in some ways, it's moved away from some of the democratic, sort of more democratic system. So, yeah, I think that's quite unlikely.
Right. Final question. There was another investment bank, who shall be nameless, that recently said that the investment opportunity in China is now over. Presumably, you'd take issue with that.
Yes, I would. As I said, I think China is a really exciting market for growth investors. It's incredibly dynamic. It's incredibly competitive. It's incredibly entrepreneurial. In some ways, the geopolitical tension with the US has encouraged China to really just double down on all of the stuff that it needs to do to ensure that it's successful over the next 10 and 20 years. And by successful, I mean continue to improve standards of living, to become a developed market country by 2049, to build these innovation centers, whether it's in semiconductors, in healthcare, in manufacturing, in automation. So there's a huge amount of stuff to be excited about in terms of the investment opportunity within China. But as I said, I would say that you have to go in with your eyes open. You have to realize that it is a different political system, and that there are challenges that come with that. It is a very volatile market. and that investment should be made dependent on the individual's risk appetite and their ability to commit capital for a long period of time.
Excellent. Sophie, thank you so much. I'm afraid that's all we have time for today, but we really appreciate your insights into the trust. And thank you all for all your questions and for watching with us. We've got more sessions like this coming up, so do keep an eye out for more from Baillie Gifford. But for today, that's all from me and Sophie. So goodbye to you all.